Hello, hello, it is the Trading Captain, and today I'm going to talk about why 95% of day traders lose money in the market, part 2. Now, before I go ahead and jump in here, I just want to say that I'm not a financial advisor. This is all my own research, my conclusions, so make sure you do your own research. And second, I just want to say that I am not selling a product or service. This is just me trying to share my opinions on the internet and hopefully get some feedback and some education out of the process. Now, let's go ahead and jump in here. In part 1, I talked about how the spread creates a negative EV environment where it is unprofitable to engage without a strategy. And real quick, EV is expected value. So it is your statistical expected return after each trade. So if you're expected that on average you're going to make 10 cents a trade, if you trade a long enough time period, you should be profitable, and vice versa. If you have a negative EV environment, if you continue trading in that environment, you are expected to lose money in the long term. So in this video, we're going to be more so analyzing how commissions and fees affect EV, because we already talked about how the spread affects it. We'll be using my data as the starting point, as the reference point. We'll break it down, and then we're going to expand into some simulations later in this presentation. So, my metrics from profitable trading. So, for the last 2 years, I've had a positive EV return, and I decided that I would go ahead. I made this YouTube channel, and I was going to document a small account on Lightspeed. So, these are the metrics from the process. I did go ahead and live stream all this too, so this all is verifiable. You can go back through my live streams. They are public, and you can verify that this is the actual results. So I traded for 44 days. It was intended to be 100, but I cut it, as we'll see in a moment. My win rate was 57.8%, pretty decent hit. Profit loss ratio, basically 1, slightly below, but not terrible. Gross profit was $213, and gross EV, which is the important one, was that my expectancy was to make $1.07 per trade, right? So across all my trades, you would expect that if I took a trade, the statistical likelihood is that I will make $1.07. So this is great. I mean, I'm crushing it, right? It looks really great to see that my metrics are profitable. I am beating the issue that I talked about in part 1, which was that the spread was creating a negative EV environment. I'm overcoming that, and I'm actually able to be profitable, right? I'm making $1.07 on average per trade. So this is great. So what is my net profit, right? So we talked about gross profit, which is just from the raw trading. What is my net profit? My net profit is negative $97. Wait, what? But you just showed all of this stuff, how your gross profit is so strong. What went wrong? So let's look at how commissions and fees impacted my EV. So as you can see here, gross gross returns was $213, but my commissions was $260. This is an incredibly high commission rate. And on top of that, the data fees, another $50 loss. Sorry about that. Just had to talk to family real quick. So like I was saying, commissions were $260, data fees were $50. So my net returns were actually red. So despite me having a gross profit of $213, my net returns were negative 97, an expectancy of 49 cents per trade of loss. So as a result, this commission and fee made my EV go negative. And this is very, very important. Especially with a commission broker, you really need to calculate this carefully. I went into this with the wrong assumption that commissions wouldn't impact me that much. I was completely mistaken. So why can't I just trade bigger size? Now, this is something that some people have asked me about. I can understand why they would think that, and if I was trading a different model, then maybe this would make sense, but it does not for my situation. So just increase your position sizing. This won't work because I am trading a per share model. And by the nature of per share models, commissions scale at the same rate of sizing. Now I have a little chart here to demonstrate this. You can see the initial scenario, which is what I showed earlier, which is my 100 shares, gross profit, commissions, data fees, all of this. And as you can see, as I increase share size, the gross profits do increase proportionally, but the commissions also increase proportionately. And as a result of this, there is never really an instance, if I'm keeping the same edge that I have, where I will ever generate more gross profit than commissions. That is just the nature of per share models. The per share model is good if your edge is strong enough to overcome the rate per share. But if it is not, then it does not matter how much size you have, you will always have that same disadvantage. And again, notice how EV per trade remains negative the entire time, right? It never goes positive. In fact, it actually gets a little bit worse as I scale. So what about per trade commissions, right? Because I was talking about per share this whole time. Why don't I just switch to per trade? So per trade commissions are much worse for small accounts. Keep in mind, I was doing this with a smaller account. This was more of an exposure test. And yeah, this really would not work well with a small account. So $3.99 per trade, $7.98 round trip is the commission model for Lightspeed, at least at the time of recording this video. And this is especially bad for partial profit taking, right? So if you buy and then you try to sell half and then sell the rest, this essentially means you're paying an extra $4 per trade, which is very, very brutal, completely not worth it at all. Specifically for a small account, maybe for larger accounts, it would be more reasonable, but for a small account, that is a very, very bad idea. And as you can see here, the EV for doing this model would be negative $8.23. So essentially, I would need to make $8.23 per trade just to break even. And keep in mind, my edge is only for $1.07 per trade with 100 shares. Now, if you scaled up to, say, 1,000 shares or more, then this would make more sense because you're increasing your share size, which isn't impacted by the commission rate because the commission is per trade. But because I'm using a small account, I can't reliably do this. So the bot army is back. In part 1, I had a 10,000 bot army that fought against the spread, and we were demonstrating how the spread can cause a lot of losses. And the good news is that the remaining bots have trained very hard. They've overcome the spread's negative EV, and now they are gross profit EV positive. So all the bots that we're going to look at for this scenario, they are all EV positive. The bad news, though, is they're still losing money because of the commissions and fees. They've encountered this new barrier that they have to overcome. And we can go ahead and look here, and we're going to look at a bunch of scenarios to see how you can perform in different commission environments. So first scenario we're going to look at is per share slight edge. Very similar situation to what we had with my scenario. The 5,000 bots will be given the per share model. They will be trading with 100 shares, the same amount I was trading with. The bots will trade in a $1,000 account and will trade 500 times or until they run out of money. The bots will have a gross EV of $1, profit before commissions, which is basically the same as what I had, a little bit less. And as you can see here, this is our bot army. We have them trading, and they're all ready to make some profits. They're very ambitious because they all are gross EV positive. Now, scenario 1 results. And if you couldn't have already figured it out, this is going to be a red result. So as you can see here, the mean, the middle, is $799. So they basically lost 200 on average. And the distribution is not favorable, right? This is the starting balance at 1,000. You can see around 60 or 70% of them ended up losing money. A lot of them lost almost everything, right? The worst case scenario, a bot lost $80. Best case, a bot made $1,600. So not really preferable at all. So we're going to go ahead and move on here, and we're going to actually look at the results from the best and worst performers. So meet the traders. The best trader was bot number 1153. They had 293 wins, gross profit of $1,380. The commissions were $700, which is quite high, and their end balance was $1,680. That was that outlier we saw earlier with the $1,600. And for the worst case, we had bot number 146. They lost 286 times. They had a gross profit of minus $220, and the commissions were the same because all bots are going to have the same commissions in this scenario. And their account balance was $80. So they lost over 90% of the account, even though they had an edge. They had a statistical edge, but they still lost money because the fees and commissions were just that brutal. So we're going to change it a little bit here, try and give the bots a little bit more of an edge to combat this, see if we can find a good middle ground to be profitable with Lightspeed. We're going to look at scenario 2, per share with a significant edge. So we're going to run the exact same scenario. The only main difference we're going to change here is that the bots will now have a gross EV of $2 per trade. And as you can see here, these are the good bots. These are the really jacked bots. They are really not messing around here. They're here to make money. They're here to win. So let's go ahead and look at scenario 2 results now that we are having a $2 expected value. And as you might expect, we are now very profitable. So we are now beyond the threshold where commissions are weighing us down, and everything is just pure profit from here. The average result was $1,301. Makes sense because that's right here at the middle line. And as you can see, even way down here, it looks like about 70, maybe 80% of traders were profitable in this scenario. And even on the low end, we didn't really have that many big drawdowns. We had a worst case $520 loss. And notably, the best case was a $2,100 win. So this is a pretty big disparity, the difference between losing 480 and making 1,100. This is a very, very preferable scenario. So we'll go ahead and meet the traders again here. The best trader was bought 3,967. They had 290 wins, gross profit of $1,800. They had the same commission fee because they're all doing the same commission fee, and the account balance was $2,100. Worst case scenario, and this one was really interesting to me to see. So the bot was 894, their losses was 289, but surprisingly, their gross profit was positive, but they still ended with a lower account balance. And this surprised me. So what it turns out is that with a $2 expected value for trading 500 times, that expected value is so high that even the worst case scenario bot, even though they had larger losses and they were the worst performer, their edge was so strong, they actually still had a gross profit, even in worst case scenario. But the reason they lost money was because their commissions were just so brutal that they couldn't handle it. The commissions were just too much. So you can see here, this is the bots. They're getting the bag. They're actually profitable overall, even though we had some bots here, for example, this one where they ended up losing 480. The overall majority did make money, and it was significant money, right? They were growing their account by a good bit, 30% plus. So now that we have that out of the way, we're going to go on to the per trade model, and we're going to reduce back to our slight edge scenario from before. So we're going to look at the devastation that this can give. So the bots are now trading the per trade model, and this is the 798 per round trip. Now, they're not going to take partials. They're just going to close the position because partials are very, very dangerous, especially with low share size. So they're going to be trading, just buying and selling. They're going to do 100 shares, the regular $1,000 account, 500 times. So everything is basically reverted back to before, but now we are just doing the per trade model. So what do you think can happen? I pretty much already spoiled it, but let's see how bad the damage actually is here. So scenario 3 results is devastating. So we had a complete wipeout. Everybody got margin called, all 5,000 of them. There were no survivors. And the only real variation is here is, where did you get margin called at? Did you lose more? Were you at $1 when you had your final loss, or were you at $10 when you had your final loss? That's the really only big factor that played a part here. So meet the traders. The best trader was no one. Everyone blew up their account. No one made money. Even the $1 gross EV couldn't save them. And this is kind of what I was saying before about how this is basically a death wish if you're trading a small account. You can't really afford the per trade model because the commissions are so high, and because you can't take large size, it is just not doable. So the worst trader was trader 122. This was just a massive tie overall, but just to show what their metrics looked like. The losses was 66. Now, they were supposed to take 500 trades, but because they got margin called, they ended up stopping early. And this is also really interesting to note. The gross profit was only $33 of loss. They weren't really doing that bad. Remember, they did have that statistical edge. The biggest reason why they blew up their accounts was just because these commission fees were just unbelievably high. And that's really what caused the devastation here. It wasn't the performance of the traders. It was the environment, the commissions. And as you can see here, everyone's just panicked. Their money's vanishing before their eyes. They're all terrified. So we're going to give them a buff now. Scenario 4, per trade and large size. Now, With Lightspeed and most onshore brokerages, you cannot use this, but if you use, say, an offshore broker, you could get around this pattern day trade rule. So you could technically trade with $1,000 account 500 times with a large size, but you would need an offshore broker. So we'll go ahead and look at this scenario now. So the scenario now is that we are trading with 1,000 shares per trade, not 100. And we can really benefit off of the commission structure here because we are doing the per trade model, we can afford to increase our share size and we will not incur any new fees. I can't speak today. But yes, in addition to raising the share size, the gross EV will rise proportionally, right? So we're trading 10 times higher share size, so we have 10 times higher gross EV. Now, because the gross EV is $10 and the commission fee is $8 roughly per trade, we would assume that because the bots are now EV positive, they should be profitable. Now, I will ask this, do you see any problems with this scenario? So if you want to go ahead and pause here and think about this, maybe think about what could possibly happen here. All right, so we're going to go on to the results. And here was the results. Very surprising to me. I did not expect this to happen. And it actually, in hindsight, makes a lot of sense. Because we are now trading with 10 times higher size, the variance is way, way higher. We're seeing very big fluctuations in returns. And as a result, because we only have $1,000 in the account, even though everybody here had a $10 edge per trade, a lot of them were just stopping out due to variance, and we had a major block wall here. Now, of those that did survive, you can see that we had some very big outliers, $8,000, $9,000 winners, very impressive, and even the mean was $1,574. So this is a statistically profitable scenario to engage with. But the unfortunate reality is just that the variance is so extreme that if you don't have a high bankroll, the odds of you margin calling and just losing everything is basically a coin flip, right? 52% of people got margin called in this scenario. So this brings up a good point that while something may be statistically profitable to engage with, I think as traders, we should be looking to survive first, profit second. So this is the kind of scenario I would really actually want to avoid, because even if you are profitable with it, if you're blowing up your account half the time, is it really a good scenario to engage with? So we'll go ahead and meet the traders here. So the best trader was trader 4252. They had 290 wins. Gross profit was $12,600. Very impressive return. And their commissions were $4,040. So very high commission rate for this per trade model, and their account balance was $9,560. So incredible result. They 9x, nearly 10x their initial balance. And the worst trader was trader number 122. And this is just because a lot of people ended up blowing up their accounts, right? They didn't even take the full 100 trades. Their gross profit wasn't really that high because ultimately what killed them was just the unfortunate variance. So as you can see here, this is a very interesting scenario. You have some traders that made a ton of money. You have a couple traders. Well, no, I shouldn't even say a couple. You had half the traders that blew up their account. So very mixed result from this scenario. All right, so we're going to tweak it again now. Scenario 5, we're going to have a large bankroll of $10,000. We're going to have large share size, and we're going to use the per trade model. So everything is going to remain the same. The only difference we're changing now is that the bots will have a $10,000 bankroll. Are we finally good? Will this finally solve the problem? All right. Scenario 5 results. And we have solved the problem. As you can see here, we have a normal distribution curve now. The bankroll started at 10,000. Looks like about 60-70% of people were profitable using this, and we didn't have any margin calls, which again checks our other box. Now, notably, the mean was a $942 average return, which is great. Shows that this is a statistically profitable bell curve, and this is really what we want to see. Now, I want to go ahead and break down the best and worst performers here, because this is really the key point to take away. So best trader was 4,198. They had 292 wins. Gross profit was even a little more because their win rate was a bit better. They made $13,000. Their commissions were $4,040, and their account balance was $18,960. So important to note here that in basically the best case scenario, this trader made $8,960. Let's compare this to the worst case scenario. Worst case was the trader number 4,039. They had 289 losses. Gross profit was $2,800 loss, and their commissions and fees were $4,040. Now, notably, I want to compare the account balances, right? So the account balance of the most profitable trader was $8,960 in profit, whereas the account balance of the worst trader was $3,160. So they ended up losing, $6,840, right? So $6,840 max loss, $8,960 max profit. This is a much more preferable scenario where you're just not blowing up your account. And as you can see here, most of the traders are profitable, but we still have some that did lose. And this is a kind of scenario where if you're trading higher variance, you're trading very large size, you need to really go into it expecting that you're going to see bigger swings, right? Higher size really should only be done if you have the capital and you have the conviction that the strategy will work. So what EV do you need to be profitable with Lightspeed? I'm going to go ahead and summarize the conclusions from these simulations. So the per share model, sizing above 100 shares doesn't matter, right? Because as you size up, the commissions scale with size. So there's no real benefit to sizing up with the per share model. Now, in general, I would assume that you would need a gross EV of at least $2 per 100 shares to have a favorable chance of profitability. Now, I want to emphasize my key wording here, which was the favorable chance of profitability, which is, of course, even though these are statistically preferable and beneficial circumstances, there is always that chance you're going to get unlucky, right? There is never a guarantee in the market. So these are really the conditions you want ideally, but they do not guarantee anything. And vice versa with the per trade model, the sizing is essentially critical. That is the solution to the per trade model. You need to take a larger size if you're doing per trade to offset those commissions, because the commissions are static. And unfortunately, because they are static, they generally need to be much higher than the per share model on the lower levels to justify them. So yeah, you need a large account due to the high variance, right? Because you need to take larger size in order to get over that higher commission. And also you need a higher gross EV to offset that. So in this scenario, it seemed like $10 worked pretty well to give a favorable chance, but depending on your risk tolerance, you might need more or less. So to wrap this up, my decision, practicing what I preach. Now, I did the experiment with Lightspeed and I was streaming it every day. And I did that for 44 days. My gross EV was $1.07 from 100 shares per trade. And from the simulations that I did, it looks like I needed roughly $2 gross EV per 100 shares to offset the commissions. And the reality is that I only have half of that requirement. So while I wanted to keep going, the reality is that this disparity is way too big. My edge was not strong enough for me to keep trading on Lightspeed, so I made what I thought was the responsible decision to say, okay, we need to pivot. We can't do a commission broker, not with my strategy at least. So that is why I ended the challenge. That is why I'm pivoting to a broker that has free commissions, and I will continue from there. So the fundamentals I believe in here. Having an edge is not enough to make money, right? I talked about in the first one where you need an edge to make money in general. Or if you don't have an edge, you don't have any business trying to trade in the market. You're basically gambling. But even after this, it is very clear to me now that you need to know your costs. You need to know how much they detract from your gross EV. And you need to not just assume that because you have a profitable system, that is all you need. You need to make sure that you're EV positive after commissions to make sure it is actually viable to even trade in this environment. And the last thing, and this is the most important thing, is don't trade in negative EV environments with real money. So if you determine that with your strategy and after commissions, you are in a negative EV environment, you should not trade with real money. It is essentially the same as gambling, and it is, in my opinion, just not really a good idea. So that pretty much wraps up the presentation. I have really enjoyed making this. I hope you found some value out of it. If you did, I would really appreciate it if you left a like. I took quite a bit of time to make this. And yeah, that pretty much summarizes my thoughts on shares for trading and a per trade model and why I pivoted away. So once I go ahead and get Webull up and can resume that, then I will go ahead and start live streaming like normal. But until then, I hope you found value out of this, and I will see you next time. Take care.